Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, September 15th, 2022. Markets are now closed. I have the after hours trades turned off, so this will just show us what we did into the close today. So we did take out, we're clearly below the trend line on QQQ, and I'm referring to this trend line, which is second draw. I had it different before, but that was the most recent one with the most number of reactions there. And we broke down here. Let me zoom in a little so you can see on the video. Broke down, back tested from below, and then we also undercut today's lows. Now look, we closed right about on there. Let me turn off everything here. So I'll say this: it's still anybody's game, but I continue to be, very clear on where I think things are going, and that's just me kind of going, from experience. If we're at where I think we're at, but I'll tell you, it's still anybody's game. These divergences, you have that PPO starting to curl up here, and I'm referring to these big 60-minute divergences. You made you had divergence right there, and you had a decent rally. You came in, you made a slight marginal new low. In fact, the divergence would come to the bottom of that candle. The volume bar is in the way right there. I'll draw it here for you. So, and it's a big part of my trading. It's not the be all end all. And as I said earlier today in that post, that written post I put out, that it would be very bearish to see these divergences get burned through. And it's something that is a lot more likely to happen in a bear market, which I still maintain that we're in. That's always debatable and, until we take out, the previous lows down here, the mid-June lows. It's, anybody can sit here and debate and say, well, that was the end of the bear market, this is a new bull market, whatever you want to say. But again, so technically speaking, it's subjective, one's opinion, whether we're in a bear market with more downside to come or that was the end, and only time will tell. Okay, but you guys know my thoughts. I made it very clear. And so going off that, I still think there's a good chance that we're going to burn through those divergences. You just have to, I sit here and talk about it because you have to respect them, because all these big rallies, and they were all pointed out in advance coming up to it, and then afterwards with these divergences forming, you had a big divergent low there. You made a double bottom effectively, maybe undercut it slightly or double bottomed it. That was a 17% rally. Then you had also a divergent low here, and there was a 24% rally. So, ignore those divergences at your peril. I'm sorry, that is a daily chart, but they were also visible on the weekly, or I'm sorry, the 60-minute chart as well. There it is. You have to zoom back, divergent low. So that's it. And so by taking out the divergences, when I say negating the divergences, and I'm referring to this as what I call potential divergence, because you have the indicators making higher lows, but they've been doing well. You have to have, first of all, an equal or lower low, which we now have. So in other words, you had divergence at that low and you did rally. You didn't have it until at least an equal low, and now we're at a slightly lower low. But these are momentum indicators, and they are pointing lower, and they could continue lower. And then once they take out that low, then you no longer have the divergence. Same with the RSI. And so that's what I'm leaning towards now. But I'll tell you what, if these divergences play out, then you don't want to stay short for too long, especially if you're an active trader. So it's the little cues, we'll look at and see. I was watching the tape today, and I like what I saw. And I go down, I trade off short-term intraday charts. There's a 1-minute chart. I could see these little rallies. Here, I'll show you on the futures. It's a little clearer. You get these little 1-minute divergent lows. That's hourly. I'll get back to that in 1 second and go to 1-minute candles here. You get these small little divergent lows. So the same divergences that can get you into the bigger swing trades on the long-term charts can play out here on a 1-minute chart. So these are just 1-minute candles. These are small moves. You get a percent or so on the NQs. You get these little divergent lows, you get a rally, and then a little divergent low right there, positive divergence, you get a rally, you get a divergent high, you get a correction, so forth, so on, and a little divergent low right there, a little tiny rally, almost divergence, almost an equal low there. And this was one we had today, and they got a little divergent low, and just like yesterday, they started to buy it up. But then they took out this trend line, and that's what you look at. You look at rallies into resistance as likely endpoints and trend line breaks, and then there was a fade after the close today. and we continue to move lower in the after-hour session. So down, and again, these are the futures, and they roll into the Globex session. Excuse me. So that's what's going on right now, and then in a minute they'll stop trading for an hour, and then they pick back up at 6 o'clock. So it's down 2%, and you can see the same thing on a QQQ 1 minute chart. You get, I only have one indicator up on this particular chart. A little PPO down there, a little divergent low, little pop. They popped that trend line, but it didn't go very far, and then they faded it. Well, then it set up this little uptrend line here, and now I'll turn on the after hours trades, and you can see that's where it broke down. And the trend line gets moved, but it was like that. Okay, so again, in summary, we did undercut those lows, and we also took out the trend line, but we closed effectively right on that previous low back here from September 6th. So, it's anybody's game. We'll know probably tomorrow. We'll either hold this level and start to rally, and if we do rally, you want to see, can the bulls take back that trend line, and then even a bigger level up here. You can see this is where we've been running into failing, about 297. They pop that, then you're going to have the divergence confirmed. You could get a rally into the Fed meeting. Like I said, I'm leaning towards it going the other way, position that way, but that's what, watch these charts. One little support level, or I'm sorry, one little resistance level, one little breakout after another, especially on the heels of divergence, it's going to increase the odds that we could rally. And we all know, or at least I know, the Fed's probably thinking what I'm thinking. They probably remember, Powell probably remembers very well back to the fourth quarter of 2018 when the market threw a hissy fit. That was when they first started to try to raise rates for the first time. They had went hawkish since the financial crisis in '08. And market threw a huge fit, dropped the entire fourth quarter big in 2018, and as I predicted, the Fed pulled a 180, gave the screaming baby what it wanted, and that was more juice. Turned around and went full blown, pulled a 180 and went dovish and took rates down again. So here's what we might see. I think we're going to see that, but there's a lot going on in the financial markets right now. Bad things. I hate to be Dr. Doom. That's not what I'm trying to be, but I watch everything. I watch junk bonds. I watch corporate bonds, treasuries. I watch just about everything is being sold down. This is the problem. The Fed backed themselves. I called it last year. I labeled it the everything bubble. They blew a bubble on everything. They kept rates too low for too long, overstimulated the economy, as did DC. Fiscal and monetary stimulus. And now those bubbles are popping, and just about everything's falling. And like I said, the big news is going to be, you'll hear about it sooner than later. These massive deficits in public pension funds, and who's going to pay for them? States are on the hook, but then they're going to probably be asking for federal money, and the federal government gives out money to everybody now to appease voters. It's just a sickening thing, but that will happen. You're going to see as I said recently, private equity is the only thing that buoyed the returns for CalPERS, the biggest of them all, in the first quarter. That's what they cited. Their stock holdings were down, regular equities down in line with the market, and it only stands to reason that private equity, you could read about it, talked about it, they're always about 1 to 2 quarters behind on their actual pricing, because they get to mark their securities to where they think they're worth, but sooner or later they're going to have to mark them down to real value. In other words, they don't trade publicly, so you don't have like Apple. You can't tell any given second of any given day. You can tell exactly what Apple's worth to the penny, because that's what the price is times the number of shares. That's what the company's value is. Private equity doesn't work that way. It's like your house. You can kind of guess and extrapolate what it's worth. And so where I'm going with that is, if everything's falling, bonds have been falling, precious metals have been falling, crude oil lately, and natural gas, private equity doesn't have a magic rabbit in the hat. Those when those get priced in, like I said, there's going to be a problem. And so I think the Fed is aware of that, and so who knows, maybe they'll come up with some shenanigans in the next week or two to try to stabilize the financial markets. Maybe they're already stepping in and buying it with the PPT. I don't know, but I've given you my thoughts and how I'm going to trade it. And if they convince me, hey, maybe start covering up on those shorts and maybe even go long for a ride. I'll tell you this, to go long into the FOMC meeting or I'm sorry, I should say heavily long or short, is obviously a pretty big gamble, because the one thing that I can guarantee you, next Wednesday, the announcement's always at 2 p.m., and then Powell's speech after is going to be volatility. The market hangs on every word. Right now, that is the primary driver of stock prices, but more so, that can cause it's causing volatility. But if you just take a step back, like I, covered today with the Wilshire, you can go to the NASDAQ 100 or SPY and just tune out the noise. I call it attenuation. Just tune out that noise. It's like taking that squelch dial, if you ever run a, VHF radio or CB radio, turn it to the static, and all that noise stops. You get a clear signal. And this is what we're looking at. Bear market rejection off the 200s. So I can sit here all day long, tell you what the Fed may or may not do, but price actions first and foremost. And then if you get in that point where I think we're at, that happens in every bear market, you get to that final point where selling just begets more selling. It's a vicious cycle. Margin calls are hit, and the more the market falls, the more margin calls are issued, the more forced selling, until markets reach a point of equilibrium. So that's all. So I'm not promising it's going to happen, but I'm thinking there's a decent chance of it. And I'll tell you, as much as I don't want to be caught in a short squeeze on the upside, I also don't want to miss out on that 20% or so drop to my next target. So that's where I'm at. Okay, let's wrap it up by just looking at SPY as well. Remember, it's not only what QQQ does, even if that's all you're trading for your indexes, that is. SPY, the S&P 500, 60-minute chart, you also took out the trend line. But look, they never really took out the lows. I mean, look, if the low of the day might have been a hair lower. Let's see, the low of the day, pop-up box says 388.70. What was that? 388.78. Yep. And the previous low from March or September 6th was 388.42. All right, so on a 400-point security, nearly a few pennies, even $1 is it's statistically insignificant. It's not much. It's a fraction of a percent. So that, for all intents and purposes, what I'm trying to say is we didn't really take out the lows. So you don't have a hard sell signal yet. It's still anybody's game. It's not looking good. The bulls are on the ropes. I'll tell you that right now. Bears have the bulls on the ropes, and if they can do this and foil these divergences, that's where I think we'll get that. Otherwise, look, as I just showed you in the beginning of the video, every other time we've had this nice, big, clean 60-minute divergence, with indicators making much higher highs, and you get the bullish crossover, you've had tradable rallies. Tradable meaning double-digit swing tradable. The kind of rallies you don't want to remain short on, and you want to get long and try to milk out as much as you can. So the key word is stay flexible. Pivot. Don't be married to anything the market must do. And if you don't know what you're doing, or you're getting whipped around in this market, now is a good time to maybe either go to cash completely, or don't trade heavy position sizes. Not just volatile things like natural gas and crude oil, but also the equity markets, especially until the Fed's out of the way. It's part of me. I will lighten up at times and even go to cash, take that my own advice that I just said. But for the most part, there's always going to be some reason, some big economic report or something coming out. And as far as trend trading and swing trading for positioning, you just at times you got to ride it out. So I'll usually at the very least just lighten up. I'm just not going to go full blown crazy, heavily short or long into a FOMC meeting, unless there's pretty strong evidence in the chart to do so. If we're in a meltdown mode in the market, those are the best to trade. I'm talking like fourth quarter 2018. We saw it, February, March of 2020, 2008, where you get the relentless selling. You can see that the dam has broken, and there's a crowded rush for the exits. And at that point, I'll push it hard. That's when I'll come in, and aggressively trade those. And then I wanted to talk on that too. So on the same kind of thing, if that starts to happen, and if it does, it could happen very soon, like I talked about, leading from here into next week, and even possibly beyond, depending on what happens after the Fed meeting. But what tends to happen there is, I keep talking about these 5-minute charts. Here's SPY. on the 1 minute charts and the 10 minute charts. You can trade these. You get these little divergent lows. You get these rallies. So these are little micro short-term trading. See that little divergent low right here? Positive divergence. Right all the way. Wow, I'm making a mess of it here. Positive divergence. You had a rally that ended with negative divergence right there. I'll draw it in. And then a correction. There's a divergent low. So one would stand to reason there's going to be a rally off that divergent low there, especially if you break some resistance levels overhead. You'd probably see a little bit better on the futures because you have more trades in SPY. But what tends to happen is if you get to that point where I'm talking about where the dam breaks, forget about these 5-minute divergences, 10, 15-minute chart, even the 60-minute charts that we're talking about now, those divergences get burned through, and that is the signature. That's when you're in the completely in the throes of a bear market. And maybe that's coming up, maybe not. Maybe it comes up later this year, maybe it's next year, or who knows, maybe the whole bear market ended back in mid-June. I don't think that's the case. Made that pretty clear lately, but I just want to mention that is an active trader, I start to lose my desire to game the little micro squiggles, the zigs and zags, especially once I believe that we're into or about to enter that point of just a relentless selling, that every little pop gets sold into. Is there's just no more buyers left. The dip buyers have finally realized, I call it a POR, point of recognition, where they realize that their whole dip buying strategy is not working anymore. Like I've said many times, this has been to me, for a bear market so far, it's been the orderly part. We've had certainly some impulsive selling throughout, but nothing even close. We haven't had any days where the futures are lock limit down, trading halts. That stuff hasn't happened yet. So, and by my volatility VIX or CPC put to call ratios and things like that, a lot of metrics tell me that the bear market's not over, and a true bear market like this one doesn't end until you've had that phase of it yet. So, all right, that's it. Okay, primary takeaways again. Good day if you're short because we were down, but nothing huge, and we're right on the line. So this can happen at any time. Futures could plunge overnight, take that out, or we could open up tomorrow. As a bear or short, you really don't want to see that trend line recovered, especially a solid recovery, and then each and every resistance level above that, because again, it just chips away. It's going to turn up the PPO, give us a bullish crossover, and then confirming the divergence, if so, and especially on QQQ here. So those are the levels to watch tomorrow. And if you want to kind of micromanage it, go down to a 5-minute chart, and you can see there's levels here. Probably, I'll leave that line up. These are all resistance levels, but there's the previous low right there, and you can see we just by the close, but now we're back below it in the after-hours session. We're right about on there. So again, for all intents and purposes, we're going to call it a stalemate because we're closed right on those previous lows. And I said they had to be taken out with conviction. That means a solid 60-minute close or a solid daily close, and that wasn't the case. We're closed right about on there. So that's it. To be continued tomorrow. What I'll be looking for, and if it does, then you get some more downside tomorrow. A good solid red day, or overnight in the futures. Even if you want to jump the gun or get in a little early, that's where you can start adding some shorts. If the futures tank tonight, take out today's lows, then you could always add to some shorts and then just set stops somewhat back above here, relatively tight stops, and see if you can get one of those snowball type down moves. And that's a nice risk reward ratio if you have a relatively tight stop. And likewise, if you see recovery there, I like to scale in and out. I like to put staggered stops if I have large quantity of shorts, and that's usually what I'll do. So it's not an all or none. I hate the all or nones because Murphy's Law says if I put a stop for all my shares right there, they're going to pop that and then turn around and dump it. So I like to scale out and scale in when I'm trend trading or swing trading. Not much of a change really in gold, silver, or the euro since that last update, so I'm going to skip that and just end the video with updates on natural gas and crude oil. Remember, crude oil still has that divergent low that it recently put in right there, but as I said earlier today, very lackluster, no follow through buying when they managed to regain that level. And said it before it happened. If they did, I'd give it a little bit of room. Now, the battle's not won for my short position yet, because they could still, all they're doing is they're back at the bottom there. But so far, like I said, the fact there was little follow through, and we even took back the 200s, and now we're back below those, tells me, and it kind of helps to confirm what I think is going on now. We're in that liquidation mode where, um, you know, uh, you know, pension funds like I talked about and hedge funds, they like me, they don't put all their eggs in one basket. They they're diversified. And so if there's just that broad-based selling, and that's what I'm seeing today. I struggle to find any sector up. Healthcare was barely up. Healthcare and financials barely up, less than 1%. Every other sector in the S&P was red. Just a lot of red across the screen. Bonds were down, everything, and then crypto was down, gold, silver down, crude oil was down, natural gas was down, the stock market was down. That's pretty much everything, and that's telling us something. So, like I said, need to take out the recent lows in crude, and that should open the door and increase the odds of my swing target of 56.80 and/or this uptrend line, whichever comes in first, will be hit. And that's still from where we closed today, about 16% drop in crude if hit. And then UNG, natural gas, divergent high 4 right there, breakdown sell signal. First support level hit, reflects a bounce back to resistance around 31, and a rejection today, closed about almost 9% down. And obviously just now traders are going to look for that reaction low there. So if that gets taken out, it should take us down to the next target, 26. But keep in mind, the nature of this beast is once it becomes clear to the masses that the tide has changed, this thing's either full throttle up or full throttle down, very little in between. So you could just slice through that 26 and head all the way down here to ultimately, I think we can come all the way down there to 19. Anyway, although maybe all the way down here to about 18 to 1958, but these are support levels along the way that may come into play and could end this. So PPO looks like it wants to curl back up, and if it does, then that means we may see a new high in natural gas. Certainly at the fundamentals for it, but this is a trend indicator. The 0 line on the PPO, and you look at the white line, the 9 EMA or the PPO signal line, and when it's above, your trend is bullish, and when it crosses below, the trend is bearish, and when it crosses above, the trend is bullish. Cross below, bearish. Cross above, bullish. Right now it's still above, and that level often acts as support when back tested from above in an uptrend. So if they can turn up here, go pop, that's the level. That high should not be violated now. That's where I think any, no matter where you got in, I think a stop, if you are short, should be right, not too far above, maybe even a hair below, because they even get close to it, they're going to pop it. So I've got stops a little bit above that all the way down to somewhere in there, but I'm on NG. I don't know where they are relative to UNG. Probably a little trend line right there. So that's what we're looking at for nat gas. And again, it'll help to see this PPO cross down below that 0 line. And if so, you'll probably get that quick swoon down. That's about it. No change in crypto, like I said. To be long and bullish the equity market is to be long and bullish crypto, and vice versa. They have almost a perfect correlation for the last all year so far. So no change there. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.